Welcome to Quick Takes. My name is Michael Antonelli. I'm a market strategist in Baird's Private Wealth Division. For today, I thought I'd give you a quick update on what we're seeing in the markets, what we're seeing from inflation in Washington, D.C., and then end on a quick talk about what is truly risk to your money. How should we be thinking about risk? Make this quick. We'll try to get under 10 minutes. It's a goal of mine. It's tough to get this stuff done in under 10 minutes, but I'm going to take a shot. So let's do this. Here's where the market stands as of October 5th. I picked two indices. I picked the S&P 500. I picked the Dow Jones Industrial Average. The S&P 500 up about 16% year to date. The Dow's up about 12% year to date. This night might not match your returns, and that's fine. You're probably in a broad, diversified set of assets. I just picked these two to talk about large cap stocks in the United States and what they're thinking and kind of what's going on. If you were to look at the economy, it's not a bad backdrop. Consumer spending is still high. Housing market is strong. Interest rates are still low. Companies have been earning more money. Estimates of kind of what they're going to earn have been going up. And their margins, kind of how much they make, those have been strong. So the stuff that drives stock markets, interest rates and corporate profits and kind of consumer spending, those are all pretty strong still in the U.S. It's not a bad backdrop for the economy right now. There's been a little bit of a sell-off. You see it right here. Since the middle of September, we've got a little bit of sell-off. Why is that? Well, if you were to look at these indices, they're very tech-heavy. These indices, these are kind of large cap U.S. stock indices. They're very tech-heavy, the Apples and Amazons and Microsofts. And those have been weak lately. Those have been kind of falling lately. Why have they been falling? This is quirky. This is strange, but they've been falling because Delta has been in full retreat in the U.S. The Delta variant is in full retreat in the U.S. You see the cases up here and hospitalizations and tests and all those things. Why would tech stocks do poorly when Delta's in full retreat? As the virus kind of ebbs and flows, the names that the stock market cares about ebbs and flows. When Delta's in retreat and there's less cases, all the kind of reopening trades do better. That's the energies and the banks and the restaurants and the airlines and the hotels. Those do better because more people engage with those when the virus kind of wanes. And that's what we're seeing. Those tech stocks get weak. The other stocks do better. That's what's called rotation. That weakness, that's been what the weakness has been in the stock market over the past month or so. It's normal. That rotation, we see it all the time in stock markets. Some sectors get more attractive. Other sectors, when Delta changes, get more attractive. It just happens. And it's just a quick reminder that risk and reward are inextricably linked. These two are inextricably linked. We've had one 5% sell-off this year. Just one. Is that normal? My friend Ryan Detrick had this great chart, which is about 4 decades of stock market returns. The blue is an annual return for the S&P 500. The dot is how far the stock market's fallen in that given year. And the line you see down here is the average pullback over those last 4 decades. We've had one 5% pullback. That's actually unusually calm. Unusually calm, my friends. The average pullback in any given year is about 14%. You should honestly expect a couple 5% pullbacks every year, one 10% pullback every year. So this is a kind of a super, super quiet year. Isn't that wild? You might say, wow, things are actually really good right now in the stock market. I know that the world doesn't seem great, but one 5% pullback is actually really calm year. A topic on everybody's mind, inflation. We hear from clients all the time about it. The media talks about it all the time, the newspapers, everyone. What's driving inflation? Why is inflation 5.25% now, which is one of the highest levels in over 20 years, essentially? Let me remind you that in March of 2020, a pandemic hit the world, and we put everybody in their homes. Everybody got stuck in their homes, out of their jobs, or in their homes. We stimulated the economy. 2 stimulus checks under President Trump, 1 stimulus check under President Biden, so we kept people's balance sheets strong while they were in their homes, out of their jobs. And then we reopened the economy in a hurry. The economy just reopened. Now all of our supply chains are broken. And that's a big issue, these supply chains. Do you know what the 3 main drivers right now of inflation are? They're used car prices, energy, and airline and hotel, airline tickets and hotel rooms. Energy prices. When the pandemic hit, the United States was producing about 13 million barrels a week of oil. Now we produce about 10 million barrels. We haven't recovered back to that 13 yet. Energy prices, supply chains are broken. Used car prices averaged about $22,000 in the U.S. for the better part of years. Now they're $26,000. Why? There just aren't enough cars. And we need more semiconductors to build more cars, and there's a semiconductor shortage. Supply chains are broken. That's driving inflation. This right here is the port of Los Angeles and the port of Long Beach. These little dots in the water are ships. You'll see the port in the kind of upper left part of the image. We can't even unload the ships. We don't have enough workers. We don't have enough truck drivers to get these goods to their manufacturers to eventually be sold to customers. Supply chains are choked globally. Energy, semiconductors, autos, all of these things. That's what's driving inflation. We just don't have enough of these things to satisfy demand. So really the two questions that I'm worried about and most smart people are worried about is what will inflation look like after we unclog these supply chains, and then how long will that take? There's no great answers to these. It's a really, really complex web of things, like everything in markets and economy. It's a complex web of things, but supply chains right now are choked, and that's causing a huge surge in inflation. Washington, D.C. is certainly on our minds. Baird just wrote an article on bairdwealth.com about the latest tax proposals from the Build Back Better Act. I would just send you there. It's really good. It's not very long. Go read it. It's got talking about things like higher tax rates and higher capital gains on couples making more than $450,000. Go there and read that. I mean, I could delve into this stuff, but this is really well done, well written. So I want you to head over there. You know, Washington, D.C., debt ceiling stuff, taxes, infrastructure bills, politics. That's a topic for another video. Can't do that super quickly, so I'm gonna head over there and read that. At the end of 2010, the United States exited the global financial crisis, and one of the best bull markets in history kicked off. 2010 to now, one of the best bull markets in history, arguably the second best bull market in history after the 80s and 90s bull market. And we've talked about a lot of things over that 11 years, lots of things, lots and lots of things. So, what do you think has been the biggest risk to your money over those past 11 years? Let's talk about a few of them. Was it who sat in the White House? There's been 3 presidents over that time frame. Was that the biggest risk to your money? Who sat in the White House? Was it who controls Congress and taxes and trade wars and political wrangling? Was that the biggest risk to your money over the past 11 years? Was it who the Fed chairman was? There's been 3 Fed chairmans, Bernanke, Yellen, Powell. Was it interest rate policy? Was it QE? Were those the biggest risk to your money over that massive bull market that we've seen since 2010? Well, in the end, it turned out to be this. It turned out to be that. In the end, that little molecule, that little virus, ended up being the biggest risk to your money, and nobody saw it coming. We weren't talking about it in videos. We weren't talking about it with our clients. We weren't talking about it in the media. That ended up the biggest risk to your money. And Carl, as my friend Carl Richards says, risk is what's left over when you've thought of everything. All these things we just talked about, supply chains and taxes and inflation and tech stocks and reopen names, if we're talking about it in a video, the market knows about it. I mean, you're here on YouTube talking about these things with me. The market knows about them. It knows what the national debt is. It knows what the inflation rate. It knows all of that. The stuff that's true risk to your money will never be seen in advance. 9/11 or the GFC or COVID, those are kind of true risks to your money. So the way I see it as a market strategist, the backdrop of the economy is still quite strong. We're dealing with inflation. We're dealing with these supply chain bottlenecks, but we have a large demographic bulge. The millennials coming into the prime of their lives. They're buying homes and cars and starting families. We'll have our ups and downs. Washington will certainly be a part of those ups and downs. But if you think about stocks and investing, you're really investing for the long run. Stocks are a bet on human ingenuity. Stocks are a bet that things get better slowly over time, and that's still the case. We'll have our ups and downs, but here in fall of 2021, the things that we talked about are well known by the market, and we just got to get through them. So thanks for coming, and we'll talk soon.